December 2025. First 4 trading days of the month. 47.6 million ounces of silver claimed for delivery from COMEX warehouses. That's 60% of all registered silver in 4 days. This isn't normal market activity. This is a vault drain emergency. And almost nobody outside the silver community noticed. Silver hit $65 in early December. Now it's at $79, still climbing. But that price action, that's just noise. The real story is what happened in the vaults. Because when 60% of deliverable inventory gets claimed in 96 hours, that's not speculation. That's not manipulation. That's a physical shortage showing itself. Let me show you why this December event was just the warning shot, and why what's coming next could send silver to 100 plus faster than anyone expects. December 2025. Delivery month. Contracts come due. Normally, most contracts settle in cash. Maybe 5 to 10% actually demand physical metal. Standard practice for decades. Not this time. Delivery requests exploded. Contract holders demanded physical. 47.6 million ounces in 4 trading days. The COMEX had roughly 75 to 80 million ounces of registered silver before this started. After 4 days, less than 30 million. Registered silver is metal available for immediate delivery. It's the buffer, the shock absorber. When delivery demand spikes, registered inventory fills the gap. Except in December, the gap was too big. They had to convert eligible silver to registered just to keep up. Eligible is silver sitting in COMEX warehouses, but not available for delivery. Owners haven't made it available. So December didn't just drain registered inventory. It exposed how thin the actual available supply really is. And here's the critical part. This happened while total COMEX inventory is 451 million ounces, but most of that is eligible, spoken for, backing ETFs like SLV, not actually available. The deliverable supply? Maybe 30 to 40 million ounces left after December. That's it. 3 things converged in December to create this crisis. First, 5 consecutive years of supply deficits. The Silver Institute reports 149 million ounce deficit in 2024. Others say 282 million. Either way, massive. That's the 5th year in a row. Cumulative deficit since 2021, 800 million ounces. Where did that deficit come from? Inventories. COMEX, London, Shanghai, all draining. Second, backwardation. Silver futures were trading below spot price. That never happens unless there's physical tightness. In December, futures were 60 cents to $1 below spot. In some contracts, $3 per contract backwardation. That's the market screaming, "We need physical metal now, and we'll pay premium for it." Third, Shanghai inventories collapsed. China's silver vaults dropped below 446 tons in October. They lost 300 tons in October alone. Shanghai used to export silver to COMEX when needed. Not anymore. They're importing. So when December delivery demand hit, there was nowhere to pull metal from. London is at 827 million ounces total, but 551 million backs ETFs. That leaves maybe 276 million available, and it's draining too. The global exchange system ran out of buffer. December was the result. Let me show you why this can't continue. Global silver supply, 1.01 billion ounces in 2024. 820 million mine production plus 194 million recycling. Global silver demand, 1.16 billion ounces minimum. Some say 1.3 billion. Deficit, 150 to 280 million ounces depending on who you believe. That deficit comes from somewhere. Exchange inventories. Now look at what's left. COMEX registered. Approximately 30 to 40 million ounces after December drain. COMEX total, 451 million. But most is eligible unavailable. London available. Approximately 276 million ounces after subtracting ETF holdings. Shanghai. Under 450 tons equals 14 million ounces. Total global exchange inventory that's actually available? Maybe 320 to 350 million ounces. Annual deficit is 150 to 280 million ounces. Do the math. At current drain rates, global exchange inventories are 12 to 24 months from critical levels. And critical doesn't mean zero. Critical means not enough to function as a buffer. When inventories hit critical, markets break. Premiums spike. Delivery delays. Cash settlements forced. December was a preview at 451 million ounces total. Imagine what happens at 300 million or 200 million. Normal commodity market. Price goes up, supply responds. Mines increase production. Problem solved. Silver doesn't work that way. 72% of silver is byproduct. You don't mine silver. You mine copper, zinc, lead, or gold, and you get silver as a side product, which means silver supply responds to copper prices, zinc prices, lead prices, not silver prices. Silver went from $30 to $79 in 2025. Mine production grew 0.9%, less than 1%. Why? Copper prices were weak, zinc prices flat. Base metal economics didn't justify ramping production. So even though silver rallied 150%, supply barely moved. The 28% of silver that comes from primary silver mines, not enough to close a 150 to 280 million ounce deficit. Physically impossible. Industrial demand of 680 million ounces is price inelastic. Solar needs 198 million ounces. EVs need silver. Electronics need silver. They'll pay $50, $80, $100. Doesn't matter. The silver content is 2 to 3% of total product cost. Doubling silver prices adds 3 to 4% to solar panel costs. Manufacturers won't stop building because of that, so demand stays high. Supply can't respond. Deficit continues. Inventories keep draining. December was a delivery month. Heavy volume expected, but January, minor month. Low delivery volumes normally. Except January 2026, open interest is at record highs for any minor month, ever. Contracts standing for delivery in January exceed any previous January, February, or April in history. The December drain didn't satisfy demand. It shifted it to January, and registered inventory is now 30 to 40 million ounces. If January sees even half the delivery demand of December, we're looking at sub 20 million ounces registered. At that point, the COMEX has serious problems. Sub 20 million is crisis territory. What happens then? Either massive conversions from eligible to registered, which just shifts the problem, or they start forcing cash settlements. We can't deliver physical. Here's cash plus premium. Once cash settlements start getting forced, the paper market loses credibility. Physical silver starts trading at premiums to COMEX futures. We already saw this in December. Dealers were selling physical silver at $3 to $5 premiums over spot. Some coins at $8 to $10 premiums. If COMEX can't deliver, those premiums go to $15, $20, $30. Physical disconnects from paper. This has happened before. London Gold Pool, 1968. Central banks tried to keep gold at $35 per ounce by selling from reserves. They sold 1,400 tons in 3 months trying to defend the price. They ran out. March 1968, the pool collapsed. Gold exploded to $200 within a decade. Hunt Brothers, 1980, tried to corner silver, accumulated 200 million ounces. Silver hit $49.45. COMEX changed rules mid-game, position limits, margin requirements hiked. Hunt Brothers forced to liquidate. Silver crashed. But here's the difference. Hunt Brothers was speculative excess, 2 guys trying to manipulate the market. COMEX changed rules to stop them. December 2025? This isn't manipulation. This is structural deficit. Industrial users need physical. Investment demand wants physical. Supply can't meet demand. COMEX can't just change the rules to fix a supply deficit. They can force cash settlements. They can halt trading. But they can't create silver that doesn't exist. And unlike 1968, there's no government stockpile. The US sold its strategic silver reserve decades ago. There's no emergency valve. If the December drain continues into January and beyond, one of three things happens. Scenario 1. Price spikes high enough to destroy demand. If silver hits $150 to $200, maybe some industrial users find substitutes. Maybe investment demand backs off. Deficit closes through demand destruction. Scenario 2. COMEX forces cash settlements. Can't deliver physical. Paper market loses credibility. Physical silver trades at huge premium to futures. $79 on COMEX, $110 for physical coins from dealers. Scenario 3. Major holder dumps inventory. Someone with 50 to 100 million ounces decides to sell. Refills COMEX vaults. Crisis averted temporarily. Which is most likely? I think we see elements of all three. Prices will spike. Some demand will get destroyed. Some cash settlements will happen. Maybe a big holder sells to stabilize things. But the underlying deficit doesn't go away. 680 million ounces of industrial demand against 820 million mine production. That math doesn't fix itself at $79 or $100 or even $120. The deficit continues until either industrial demand drops significantly or mine supply surges. Neither is happening. Based on December's drain rate and current inventory levels, January 2026, watch registered inventory. If it drops below 25 million, red alert. Delivery requests will show if December was one-time event or new normal. Q1 2026. March is major delivery month. If March sees anything close to December's demand, registered inventory could hit sub 15 million. At that point, COMEX is in crisis mode. Q2 2026. Either they've stabilized, unlikely given structural deficit, or we see functional default. Cash settlements forced. Physical premiums explode. Could happen faster? Yes. Another vault drain like December in January or March pushes timeline forward. Could take longer? Yes. If delivery demand normalizes, if a big holder sells, if recession kills industrial demand. But bet on the middle. 3 to 6 months from serious problems. 6 to 12 months from paper market breaking. If you're holding physical silver, December confirmed your thesis. The drain is real. The shortage is real. The exchange system is fragile. Do you sell at $79? Your call. But if you believe December was the start of a systematic vault drain, then $79 isn't the top. If you're thinking about buying, understand what you're buying. You're not buying silver because it's cheap. You're buying because COMEX just lost 60% of registered inventory in 4 days, and they're running out of buffer. Risk? Silver could correct 20 to 30% anytime. Volatile asset. Maybe COMEX stabilizes. Maybe recession kills demand. Reward? If vaults hit critical and paper breaks, physical could trade $30 to $50 premium to futures. $100, $120, $150 becomes the physical price while COMEX quotes $80. Watch these metrics. COMEX registered, below 25 million equals danger, below 15 million equals crisis. January delivery. Record demand equals December wasn't anomaly. Physical premiums. If dealers charging $10 plus over spot equals shortage. Backwardation. Persistent backwardation equals system stress. December 2025. 60% of COMEX registered silver claimed in 4 days. 47.6 million ounces. Unprecedented. What's left? Maybe 30 to 40 million ounces registered. Against 150 to 280 million ounce annual deficit. Against 680 million ounces industrial demand that can't be reduced. The math doesn't work. The buffer is gone. And January delivery is about to show if December was a one-time event or the new normal. If it's the new normal, we're 3 to 6 months from COMEX having serious problems. And when the world's primary silver exchange can't deliver physical metal, the price discovery mechanism breaks. Physical silver holders win. Paper holders find out their contracts settle in cash, not metal. Subscribe for updates, because January delivery data drops soon, and that tells us everything about what happens next.